Hi, I'm Jessica Rabe, one of the co-founders of DataTrek Research. I have a quick but very important data-driven video for you today on how calendar Q2 2025 corporate earnings results and more recent developments have impacted Wall Street analysts' earnings estimates for U.S. big tech going forward. And just note that we do include Broadcom in this list. Now, this is important because these 8 US big tech stocks, NVIDIA, Microsoft, Apple, Alphabet, Amazon, Broadcom, Meta, and Tesla, collectively make up over a third or 37.5% of the S&P 500 by weighting. That's more than every S&P 500 sector, including technology itself, which has a 33.8% weighting in the index. They therefore have an outsized impact on the S&P's performance. This table shows the 90-day trends in analysts' calendar Q3, Q4 2025, as well as 2026 earnings estimate revisions for US big tech. The analysis here allows us to gauge analysts' perceptions about each company's fundamental momentum and their confidence in earnings growth for the rest of this year and next. Not only does this table have that data, but also how estimates have changed over the last 3 months for the S&P 500 with data courtesy of FactSet. I have 4 points to make on this data. The first is that over the last 90 days, every US big tech name except Tesla has seen meaningful positive earnings estimate revisions for the last 2 quarters of this year and 2026. On average, analysts have raised their big tech earnings estimates by 4.4 and 0.8% for calendar Q3 and Q4 2025 and 3.6% for 2026. Excluding Tesla, the average revisions increased to 5.6 and 4.2% for calendar Q3 and Q4 2025 and 6.1% for next year. These are truly excellent numbers. When excluding Tesla, these positive revisions are 5.3, 3.4, and 4.7 percentage points better than those for the S&P 500 in Q3 and Q4 2025 and 2026, respectively. For reference, analysts have bumped the S&P's earnings estimates up by 0.3 and 0.8% for Q3 and Q4 2025 and 1.4% for 2026. Further, even when including Tesla, big tech's positive revisions are 4.1 and 2.2 points better than the S&P for this quarter and next year, and the same for next year. My second point is that every US big tech name has better earnings estimate momentum than the S&P as a whole for this quarter and next, except for Tesla once again. As you can see on the table, analysts expect anywhere from 3.1 to 13.2 average growth from each US big tech name, excluding Tesla, this quarter versus 0.3% for the S&P and between 2.1 and 7.7% growth for next quarter compared to 0.8% for the index. These are truly remarkable numbers, and the outlook also looks great with respect to 2026 estimates. Analysts expect anywhere from 2 to 13.3% better growth next year versus 1.4% for the S&P. Now, on the other end of the spectrum, Tesla continues to have terrible earnings estimate momentum for calendar Q3 and Q4 2025, down 3.9 and 23% respectively, and is down 4.2% for 2026. Now, to be fair, Tesla doesn't really trade on near future earnings, but rather Elon Musk's long-term vision. Third, big tech's performance generally lines up with Wall Street analysts' earnings estimate revisions. The 5 best performing US big tech stocks with double-digit year-to-date returns also have solid positive earnings estimate revisions for next year. These are Broadcom, Meta, Alphabet, NVIDIA, and Microsoft, which are all up between 21 and 49.3% year to date, and their 2026 EPS revisions range from 2.8 to 13.3% versus 1.4% for the S&P. All 5 stocks are also leveraged to Gen AI. Even Alphabet is making a comeback on this technology, with Gemini becoming the #1 free app in the US Apple Store last week. And of course, its favorable antitrust ruling in its search case to not have to break up the company earlier this month has also helped the stock. Fourth and lastly, US Big Tech's average year-to-date performance is almost double the S&P, up 20.9% versus 12.2% year-to-date, and even better, up 23.1% when excluding Tesla. Only 3 US Big Tech stocks are lagging the broader US equity market this year. That's Apple, down 4.6%, Tesla, up 5.5%, and Amazon, up 5.6%. Tesla faces demand challenges, especially in China, and other company specific issues. Apple is also highly exposed to US China trade relations and has an underwhelming product pipeline when it comes to Gen AI. And while Amazon is an AI hyperscaler, it is also subject to the strength of the retail sector and consumer demand amid a weakening US labor market. Let's move on now to my final takeaway from all this data. US big tech names have superior earnings estimate momentum in the second half of 2025 and heading into next year relative to the S&P 500. An important fact we rarely see mentioned for these key names. These strong fundamentals should enable US big tech to drive the S&P higher through year end, and also supports their and the S&P's elevated valuations. With that, thank you very much for taking the time to watch this video. Please hit the like and subscribe buttons if you enjoyed it. You can check out our daily investment newsletter by signing up free on our website, datatrekresearch.com. There's no credit card or personal information required. You just have to drop an email in. Thanks again for watching, and we hope you have a great day.